Hi everybody, this is Lara with your end of the week video for the trading week ending Friday 7th of August for the S&P 500. There is still an upward trend in place and I have two targets for it to end. It may end prior to 3432.15 for the second wave count, or it could end about 3640. If we see a new all-time high, that would add confidence to a bullish view for the short or mid-term. But while we don't have a new all-time high, the bearish counts do remain valid. I've got 4 wave counts for you at the end of this week, and if you haven't reviewed the monthly chart analysis, which I updated and did a video for in the middle of the week, I strongly recommend that. Elliott Wave is fractal. You have to fit it into the bigger picture. This wave count sees the bull market differently from the bearish wave counts. It sees the bull market for super cycle wave 5 as incomplete, with cycle 3 here, cycle 4 a big expanded flat correction subdividing 3, 3, 5, and cycle 5 beginning here. The target for cycle 5 is for it to reach 2.618, the length of cycle 1, when primary waves 1, 2, 3 and 4 for this wave count within cycle 5 may be complete. Then I can add to the target calculation a primary degree. At that stage it may widen to a small zone, it may change, or I may have 2 targets for you. At this stage an impulse may be unfolding higher. I'm going to label it for this wave count primary wave 1, intermediate 1, 2, 3, 4 and intermediate 5 continuing. When primary wave 1 is complete, then this wave count will expect a deep multi-week pullback for primary wave 2. If primary wave 1 takes price to a new all-time high, then the bearish wave counts would be invalidated, but we would still be expecting a deep downward movement for this count for primary wave 2. Although for the S&P, its second waves aren't actually always that deep, we would still be expecting at least a multi-week pullback for primary wave 2. Primary 2 may not move beyond the start of 1. Let's take a look at this at the daily chart level now, where the high for primary wave B of that expanded flat, here's primary C, and now that completes cycle wave 4, and this may be where cycle 5 has begun. So far, intermediate 1, 2, 3 and 4 within primary 1 may be complete. Intermediate 5 may have begun with a leading contracting diagonal for minor 1, a little zigzag for minor 2. Minor 3 could now be complete at the high for this week, and minor 4 could possibly also be complete. We may now need only a short little wave up for minor 5 to complete intermediate 5, to complete an impulse for primary wave 1. If minor 4 continues further sideways or lower next week, then it may not move into minor wave 1 price territory. The short-term invalidation point remains. There's a limit here for intermediate wave 5 because intermediate 3 is shorter than intermediate wave 1, and a core Elliott wave rule states that this third wave may not be the shortest out of 1, 3 and 5. That means that the fifth wave is limited to no longer than equality in length with the third. It needs to end at or before this point. A new high by a fraction of a point on a tick chart invalidates the way I have labelled this upward movement. At the hourly chart level, we're now looking at the end of minor wave 3. Minor 4 could be over. It would be a very brief, shallow, flat or zigzag. That's okay. Fourth waves for this particular market can be more brief than their counterpoint second waves, and the second wave wasn't that time consuming anyway. It was over in a session. So minor 4 could be over here, but if it continues sideways or lower, which it could do, it may not move into minor 1 price territory. I have to leave the invalidation point down here to allow for that possibility. Minor wave 5 looks like it may continue higher next week, and it should end at or before this limit. At the daily chart level, this wave count is exactly the same as the previous daily chart, except I've moved the degree of labelling within cycle 5 all up 1 degree. This is for the short term a bullish wave count, but for the mid to long term it's actually an extremely bearish wave count. If cycle 4 was over there as that big expanded flat and cycle 5 begun, then it could be relatively short. Cycle waves 1 and 3 were extended, so cycle wave 5 could be relatively short, and primary 1, 2, 3 and 4 within it may all be over. Primary 5 may be very close to completion, and the limit is the same because primary 5 may not be the shortest out of 1, 3 and 5, and primary 3 is substantially shorter in length than primary 1. The subdivisions are all the same. For primary 5, a leading contracting diagonal for intermediate 1, a brief shallow zigzag for intermediate 2, an impulse for intermediate 3 may now also be over. Intermediate 4 may continue a little sideways or slightly lower next week, and it may not move into intermediate wave 1 price territory, and it also could have been over at Friday's low. That's also possible, but for this wave count, for a correction at intermediate degree, I would expect it to continue a little further. When it's done, a final short upward wave for intermediate 5 may be all that's required to complete the bull market. Cycle wave 5 has already moved beyond the end of cycle wave 3, so it's avoided a truncation. It doesn't need to move beyond the price territory of cycle 4 to avoid the truncation. The term truncation, when it's applied to a fifth wave, refers to where the fifth wave ends in comparison to its counterpart third wave. But it would still be fairly likely for cycle 5 to at least make a new all-time high. That would give the whole wave count a much more normal look. And so it has to end at or before this limit, and it could be over quite soon. So this is actually a reasonably bearish wave count. We could have a trend change at grand supercycle degree coming up soon. At the weekly chart level, the next two wave counts see the bull market in a very different way. The labelling is very different, and it sees an impulse complete back up here. To see the difference, you need to view monthly charts, which is why I updated them this week and provided a video. This wave count has a better labelling, in my opinion, of the bull market, because when we label the 1, 2, 3 and 4 waves within the bull market in the positions for this wave count, the Elliott channel fits absolutely perfectly. It's just textbook perfect. In the middle of the bull market, the third wave of the third wave overshoots the upper edge of the channel. You can see that on the monthly charts, but not on this weekly chart. So when we label that bull market with 1, 2, 3 and 4, and the channel has such a perfect fit, it looks like that's the correct labelling, and it also agrees with MACD. If this is correct, then we may have had a trend change here and a bear market may be unfolding. This wave count considers this bull market may have only been a cycle degree first wave, and now a cycle degree second wave should continue lower. It'll be extremely unlikely to be over there. We could try and see this as a three-wave structure. That would fit, but that would be too brief and shallow for a second wave at cycle degree. It would most likely unfold as a zigzag labelled A, B, C, and if I have this correctly analysed as a five-wave structure, then B may not move beyond the start of A. It's also possible we could see this as a 3, and cycle 2 could be an expanded flat. A, B could move beyond the start of A, but I'm not publishing that idea because it just doesn't differ at all from my second wave count, which expects just a little bit more upward movement and then a huge trend change. In future, if that idea does start to differ in expected distance travelled and direction, and when a trend change is expected, then it may add to the analysis, and then I'll publish it. I think at the moment 4 wave counts is really more than enough to wrap our heads around. Let's take a look at this idea at the daily chart level, where this high for cycle 1 may have been this point up here. Primary A fits very well indeed as a 5-wave impulse. If that's correct, primary B may not move beyond its start. Primary B may be extremely close to finishing. It can't move beyond the start of primary A. When primary B may be complete, then a big trend change and a big downward wave for primary C would then still be expected. At the hourly chart level, here's the end of intermediate B. Actually, I'm just going to go back to the daily chart. This daily chart actually has a better fit within this upward movement than the first two wave counts. So at all points, these second two wave counts do still, in terms of Elliott Wave, do still have a better fit in how the subdivisions are seen. Primary B is here seen as a zigzag, A, B, C. Intermediate A is an extended 5-wave impulse, 1, 2, 3, 4, 5, and minor wave 5, an ending contracting diagonal. Intermediate B, a running contracting triangle. This neatly explains all of this overlapping in these days back here, and this has a better fit than the first two wave counts. One of the problems for the first two wave counts is seeing that very brief shallow second wave correction after a leading diagonal. Second waves following first wave leading diagonals are usually very deep, and so that does reduce the probability of that labelling for those first two wave counts. I hope that's not too complicated. Suffice to say that the third and fourth wave counts in terms of Elliott Wave do still have a better fit, but with that gap closed, my analysis must now lean more bullish, because that's quite a bullish signal for that gap created on the 24th of February to be closed. So it's for classic technical analysis reasons that the probability of these bearish wave counts has reduced. Okay, at the hourly chart level, here's the end of that contracting triangle for intermediate B. It beautifully explains all that overlapping. And now from this low on upward, this absolutely looks like an impulse. 1, 2, 3, 4, 5. 4 could be over, and only a slight new high may be required for 5 to move beyond the end of 3 to avoid a truncation, although I think it may have already done so. But just a little bit more upward movement could complete the structure for primary wave B at all wave degrees, and then a big trend change could be expected early next week. This does remain possible, but with the closure of that gap, I have to judge it now as having a lower probability. This will remain possible unless we see a new all-time high. And finally, at the weekly chart level, this wave count is extremely bearish and expects the bear market may have begun already. It moves the bull market, labelling all up 1 degree from the last weekly chart. All the subdivisions are seen in the same way, and this has a really, really good fit. It's possible we may have seen a trend change at grand supercycle degree in February this year, and the start of a huge bear market, to be labelled grand supercycle 2, to most likely subdivide as a zigzag. So supercycle A would most likely be a 5-wave impulse. Cycle 1 may be complete. Cycle 2 may not move beyond the start of 1. There's no option for an expanded flat here, so a new all-time high above this price point absolutely, immediately, fully invalidates this extremely bearish wave count. Classic technical analysis now. At the weekly chart level, prices closed at highs for the week. A really reasonably strong upward week, but a slight decline in volume. That's actually, I'm not going to read that as bearish, because this has long been a feature of this bull market. Rising price on light and declining volume. It's especially apparent when you view monthly charts. I think what that means is eventually when the market does turn, and it will turn at some stage, eventually when it does, it could be a particularly swift fall in price, because support below is very thin, so there's not a lot to hold up price when it eventually is ready to fall. On balance volume is making new highs prior to price. The last signal it gave was a break above weak resistance. That's a weak bullish signal. This bullish divergence here between price and on balance volume, I do not give a lot of weight for the reasoning behind that decision. Look at the second half of the global financial crisis. For the second half of that big, strong bear market, on balance volume was making new highs, yet price continued to fall quite strongly, and so I give little to no weight to this divergence. RSI is in neutral territory. It's quite a way off its deep overbought condition back here, but price isn't actually that far off new all-time highs. So if price does make new all-time highs, we're probably going to see quite strong bearish divergence between price and RSI. We're not there yet though, but that's something to look out for. ADX is declining after telling us the previous downward trend reached extreme. It indicates a potential trend change to up, but this is based on a 14-week average. It's a lagging indicator. MACD is full bore bullish. ATR declining as price moves higher is absolutely normal behaviour for this market. At the daily chart level, we have this bearish divergence here between price and RSI, but it is weakening. Sometimes it just disappears. So far, with the data in hand, there is some bearish divergence there. Price is moving higher on up toward that target calculated from the flag pattern. To calculate a target from a flag, take the flagpole, which I'm calculating from this low to this high, add that distance to the breakout point from the flag. An upward breakout from a bullish flag requires support from volume. This one had it, and so the target at 3405 is still in place. I will expect price to continue on higher until it reaches that target, is fairly likely now. Look for support quite strongly about 3200. ADX indicates there is an upward trend and it is not yet extreme. There is room for the trend to continue. RSI is not overbought. There's room for this trend to continue. ATR is flat as price moves higher, normal behaviour. The last signal from on-balance volume here was bullish, a break above weak resistance. It's making new highs again prior to price, but again, I'm not going to give that weight. MACD is bullish, fully so, and stochastics is overbought, but when this market trends, it can remain overbought for quite a while price can continue a reasonable distance. The AD line is making new all-time highs. Usually I would read that as a very, very strongly bullish signal, but Lowry's operating company's only AD line has still not made new all-time highs. It's actually still a reasonable distance away from new all-time highs. I'm reading that lack of confirmation from Lowry's OCO line as bearish. If Lowry's OCO line also makes new all-time highs, then this analysis would become necessarily even more bullish. It's normal or most common prior to the beginning of a fully fledged bear market for the AD line to have at least 4 months of bearish divergence with price. That bearish divergence with price can extend to years. It did before the bear market, which began in 2000, the dot-com crash. There are now 3 instances in the last 98 years where a bear market developed after zero divergence between price and the AD line, and here is the third. The previous one was, I think, 1946 and 1976, and in all 3 of those instances, the bear market that developed was relatively shallow. And this one, if it's over here, on the 23rd of March, was relatively shallow. This meets the technical definition of a bear market because it corrected more than 20% of market value. So this is a bear market coming after zero divergence between price and the AD line. If it's over here and price continues on to make new all-time highs, then it would be a shallow bear market following zero divergence, and that pattern would be intact. And so if that happens, if we see new all-time highs, then this would be a continuation or a new bull market following this bear market, and then I would be looking for some bearish divergence to develop between price and the AD line. And at this stage, there is absolutely none. There is bullish divergence. And what that all means is, if price makes new all-time highs in the next 1 or so weeks, which if it's going to, it should do so next week, if that happens, then I'm going to be, this analysis will be quite bullish, and it will be bullish for at least 4 to 6 months, as most likely, because I'll then be waiting for that bearish divergence to develop before I can have an expectation of an upcoming big trend change. At the daily chart level, price is moving higher, the AD line is moving higher. This upward movement has support from rising market breadth. But when we take a look at mid and small caps, let's go back to the weekly chart. Only large caps have made a new high above this high back here in June. I think this is the 8th of June, the date on the daily chart where this high sits. Only large caps have made new highs. Mid and small caps are below these previous recovery highs. And so this upward movement here is led mostly by large caps. Despite the AD line showing new all-time highs, there is actually some weakness within that upward movement. And that's a feature of an aged bull market being led by large caps. Okay. Price and inverted VIX still has well over 2 years of extremely strong bearish divergence. This was a harbinger of this big, strong fall down in price. It was hopeless as a timing tool, but it was one strong piece of evidence to look out for something like this to happen. Inverted VIX and price have both made new short-term recovery highs. Price is quite close to its all-time highs, but inverted VIX is a very long way for the mid and long term. It still would have, if price makes new highs next week, there would be increasingly strong bearish divergence between price and inverted VIX. So that is still a piece of evidence pointing to the possibility for the bearish case that I have to keep in mind. As price is making new highs here, VIX is making slight new lows here, and VVIX is slightly above those. So there's a little bit of bearishness for price here in this divergence, but it's pretty weak. And finally, at the daily chart level, price is making new highs. For the short term, inverted VIX is also making new highs, and so there's no divergence for the short term at the end of the week. That's all from me at the end of the week with your S&P analysis. I hope all our members are having an awesome weekend.